We're back again. I think the last one was a couple of months ago, and we've had a lot of interest in this one, and I think it's a really exciting theme, which is the EIS versus VCTs. What are the differences, strategies, etc. So we'll hopefully get into some of the detail, work out what those are, and see which is the overall winner. So first of all, really thank you to one of my colleagues in the background, Chris, who's helped to put together this fantastic panel. And we'll do a little round of introductions and I'll go at the end. So Nish, you want to go first?
Thanks, Sunil. So my name is Nishil Patel. I am Head of Private Client Fundraising at MMC Ventures. I've been here for 8 years. We are one of the more established EIS funds. We invest into deep tech software and have consistently delivered our target returns. So yeah, I deal with all of our intermediaries and direct investors. Thank you.
Awesome. Thanks, Nish. Tom?
Perfect. Yep. So I'm Tom Healy. I head up fundraising at Haatch, which is a leading investor in business-to-business software companies at the early stages, and we operate both an EIS and an SEIS fund.
Thank you. Fran?
Thank you. I'm Fran Rayneau. I co-head the investor relations team at Calculus Capital. We are an EIS and VCT fund manager. We've been in the market for over 25 years and we invest across tech, healthcare and entertainment.
Thank you. Stephen?
I run a small IFA practice. We do a phenomenal amount in the tax advantage space and have done for 30 odd years. And wearing my other hat, I'm the main board director of the Enterprise Investment Schemes Association.
That's fantastic. So I'm Sunil. I think hopefully most of you online might know me, given that we have a number of these ChaiTime, but I've just realized we've reached out to sort of all your databases as well and all your IFAs, so maybe they won't, so I will do a quick intro. So I'm Sunil, I'm a fund manager at o2h, and o2h is a group company. So we have a number of sister companies that run the fund. We have a knowledge intensive fund and an SEIS fund, so we have 2 funds running concurrently. We're a specialist biotech fund, so we only do biotech. And we have around 35 companies in the portfolio, and so yeah, we've recently won an award as Biotech Specialist Fund Manager of the Year, which we're very proud of, and we have no VCT, and I'm going to go straight into this now because I don't want to lose out on. We go straight to Fran, who's our only VCT on the panel. So Fran, I want to sort of get into a little bit of the details of what a VCT is, how it's structured, what the tax incentives are, and what investors should be thinking about when investing into VCTs. So I'm going to go over to you first.
Yeah, of course. So in a nutshell, VCTs are investment companies and they're listed on the London Stock Exchange. So as an investor, you purchase shares in a VCT and you'll receive immediate access to a portfolio of high growth, small UK-based companies. Now, typically, the portfolio is in the region of somewhere between 50 and 100 companies. Of course, there are larger VCTs out in the market. There are smaller VCTs out in the market. But you're gaining that instant access to a ready-made portfolio. And as a VCT manager fundraises, they will also put money to work into new companies and also follow on in their existing portfolio as well. So the main similarity with the EIS is that you'll get that 30% income tax relief on your investment, but it's only in the year that you make the investment. And I'll let the other guys speak about the carryback with the EIS that's available. And this income tax relief certificate is available as soon as the shares are allotted. So there's no waiting for any deployment time. So that is one of the similarities. A key difference with VCTs versus EIS is that it is designed to give you a tax-free income. So typically a VCT will have a dividend. It's usually annually. It's usually around 5% annually. And that is, given to the investor, so they have this tax-free income. And what investors really like about VCTs is that if they invest in multiple ones, they're getting this income throughout the year because VCTs pay their dividend at different times of the year. I think another key difference as well with VCTs versus EIS is the diversification. So as mentioned, you get this big portfolio of companies usually. Like I say, somewhere between sort of 50 and 100 is kind of standard. So you're getting a really nice diversified large portfolio. and you own shares in the VCT. Whereas with an EIS, a portfolio is typically around 8 to 12 investments, and you hold shares in the underlying companies that make up your EIS portfolio. The third key thing I want to mention as well as a difference is the liquidation point. So with a VCT, you have to hold the shares for 5 years to retain the 30% income tax relief. And after 5 years, you can then apply for a buyback, which essentially means that the VCTs buy the shares back from you, typically at a discount to NAV. Industry average is around 5% discount to NAV. But what it means for investors is that they know that they can hopefully get an exit point after the 5-year holding period. With an EIS, you're at the mercy of the fund manager making an exit. It could be 3 or 4 years, it could be anywhere up to 10 years. So you'll be getting piecemeal exits throughout your holding time of the investment. So that's essentially, in a nutshell, what a VCT is and what it's designed to do.
That's fantastic. I'm going to come back to Nish and Stephen in a second, because I think we can talk about some more broader topics with this. But I'm going to ask Tom to give us a summary of EIS and SES and what the main tax benefits are for those products.
Yeah, absolutely. Perfect. So with EIS starting off, the kind of typical headline grabber is that it's 30% income tax relief that you get to claim either in the tax year that the funds are deployed or the year previous, which is known as carryback, which Francesca alluded to. And then there's also capital gains tax deferral that's available with EIS. So again, I believe it's up to 12 months before and up to 3 years after a gain has realized, you're able to defer 100% of a capital gain by reinvesting it into EIS shares until such time as the shares realize, and then you have to pay the capital gains tax back. And then with SEIS, it's similar to EIS in that it's 50% income tax relief, again, able to be claimed in the year of deployment or the year previous to that. But the difference with capital gains tax is that there's reinvestment relief on offer, which is 50% of the investor's capital. So 50% of the amount you invest into SEIS shares gets to be knocked off any chargeable gain that you have that year, therefore reducing the bill as a result. And that's a permanent reduction and does not have to be paid back.
I mean, a couple of points there, which I actually didn't understand the differences until we had the pre-call. One is that I thought that the VCTs would invest in a different type of company because they'd be more sort of revenue generating to produce that kind of dividend. And EIS and SES is maybe more kind of the tech, biotech, university spin out type things, which would be less revenue focused and more growth focused. But Fran corrected me on that yesterday, and maybe Fran, you could just quickly say, what are the different types of portfolios underlying, or are they the same companies and it's just a different sort of tax structure?
Yeah, I think talking on behalf of Calculus, we have a co-investment structure. So our investment team will look for the company and then we'll apportion some into the open tranches of our EIS fund and into the VCT as well. So as mentioned, you get a broader portfolio with the VCT, but we are making the same investments into both. And actually, the qualifying companies are the same across both products as well. I think
would you say the risk profile, I mean, from a Stephen Jones point of view, and I'm sure he'll be thinking about this from his client perspective, they're always worried about risk and de-risking. Do you think from a risk profile point of view that's similar, given that the same companies, or it's different?
Given that the same companies, the risk profile of those companies failing is absolutely the same, or being a success as well is absolutely the same. I think the reason why they are deemed to be less risky, VCTs are deemed to be less risky, is a diversification point. You're spreading your risk across, let's say, 50 companies in a portfolio. If one fails, that's completely diluted, can be completely diluted depending on the holding. Most managers have, they cap their largest holding at Calculus. Our largest holding is less than 6% of a portfolio. So you don't see those losses as heavily. But on the flip side, you also don't see the successes as heavily. So if you've got a massive, return of 10x with EIS, the client will get that 10 times back into their bank account. With a VCT, it funds a dividend stream. And of course, the VCT can choose to pay a special dividend if it's a really large exit, but they are relatively rare. So I do think most managers will adopt a co-investment strategy. I think you are right in the sense that some managers would have used their EIS to feed into their VCT. I think that has happened in the past. It potentially might still happen. It doesn't happen at Calculus, so I can't comment too heavily on it. But it is the same underlying companies. And I think you mentioned, obviously, because you're a biotech specialist, that potentially it lends itself better to the EIS. And I think you're right in the sense that you get a loss relief with EIS. But I also think that with the EIS, there is also a certain amount of pressure to exit within a time frame. You know, investors will put their money away and they'll be calling their financial advisors saying, it's been locked up for 7 years. When's this company going to exit? And for VCTs, you don't quite have that same amount of pressure. Of course, you need exits to fund the dividend stream, but it doesn't mean that every company to be exiting.
Let's bring in Stephen and to give the IFA perspective. I mean, what are your clients thinking about? What are you thinking about when you sort of select a VCT versus ES? And Nish, you're coming in next and sort of the broader landscape in a second. But Stephen, over to you to give us your...
Well, first of all, I thought Francesca made a whole stream of excellent points. And I was nodding my head pretty continually I just agree with virtually everything that was said. From an advisor's point of view, in fact, now I'm going to comment more generally on VCT. When we're picking VCTs, one of the things that we do look at is ultimately what we're after with the client. So sometimes if we're looking at a VCT from a company that's initially being primarily in the EIS space, which has been quite common for many, Calculus has the huge advantage. It's a very long, well-established company. And so therefore, its VCTs don't have quite the same correlation that perhaps some of the younger guys have, where a lot of their VCTs have really been follow-on funds to provide that additional capital to companies that they've seeded initially. And I'm quite certain that's understandable and you accept that. From a client perspective, we take that into account. So we look at what the overlap is between the VCT and the EIS, and we'll then make a judgment call whether we want further exposure or not. Because one of the things that we've not been able to do is ask a VCT provider, can our client not go into a particular company because we feel that the exposure that they have with company X is sufficient. So in those examples, we would tend to use a VCT from somewhere else. So that's that.
Does IHT factor in a bit more since, post-budget? Because, I think from what I understand, the VCTs are not IHT exempt, whereas if you hold the EIS underlying investments, they are IHT exempt.
They are, yes, obviously after the appropriate bedding in period. It doesn't really take, in fact, no, from a planning point of view, that comes down to what the client's overriding criteria is. So if it's all about IHT planning, then that's definitely an issue that you would take into account. And that's that balancing act that any planner does between what are the client's objectives? Is it much more about risk? Is it much more about inheritance tax planning? Is it much more about investment? And that's the joy of a planner. It's about sitting with the client and managing those quite often conflicting objectives.
Yeah, no, it's a great point. So Nish, what's your perspective on, give me the pro-EIS?
Pro-EIS, yeah, well, it should be, for me, it's about the investment case, right? So I think when you think about EIS and VCT as well, what are they actually investing into? And the themes, for me, it's venture capital, it's technology, it's life sciences, and it's access to early stage innovation, which is a very interesting and exciting area to invest in. But purely it's about capital growth. So in an extremely tax efficient way. When I talk about EIS, the EIS reliefs are just so generous, and to think that you're actually investing into companies which could deliver a 10-15x return, obviously that blends out a portfolio, not pay any tax on the gain, have the risk mitigation of the loss relief, and the tax relief, income tax relief on day one. That's pretty compelling for me. So for investors that are looking to diversify their portfolios, get access to alternatives, private assets, it's just a really good channel to come in.
Is there any data out there that we can understand to show the returns that an EIS fund over a period of time, or VCT? Because VCTs have been around some time now. Is there any data to show over a 10-year or 5-year period which outperforms?
I don't think that's a fair comparison. Sorry, Nish.
Yeah, go on, Stephen. Why over 10 years?
I think they're different vehicles, different profiles. I just don't think you can compare in that way performance. Back to Nish.
I think there is definitely comparables within the EIS market or within the VCT market, but I think, as Stephen said, they fulfill different needs.
Yeah.
If you can find a VCT which has a decent MBO portfolio or has a good track record of exiting companies and can deliver a 5% return, which is tax-free, plus the income tax relief, pretty compelling, right? You just have to have faith in that fund manager to continue exiting companies or have that MBO portfolio which continues to pay dividends. On the EIS side, so EIS, the performance, frankly, across the market, it rarely justifies the risk. So you really have to have a firm understanding of how to build a panel to, run proper due diligence processes, to pick fund managers which are actually delivering returns. And it's actually interesting because the market has gone through a lot of change, legislation change in the patient capital review. Today, it's all about growth. And there are established.
I'll come back to that. It's a really good point there. I want to. That's in the sort of second part of agenda, but this is a really, really good point. Is that how the impact that EIS and VCT is going to have on the government's agenda on growth? But just to come back on that. But yeah.
Well, just there's one stat that I pulled earlier, which is in 2023, £8 billion was invested into UK venture-backed businesses. In the same year, £2.5 billion was raised by startups or early-stage companies via EIS and VCT. It's such a critical part of growth capital in the UK.
Coming back, Nish, that is like a fantastic point. But the whole landscape thing is something we are going to touch on. And I think it's really, really important that we give it a proper airing on this podcast or ChaiTime, whatever we call it. So let's just hold that point and that thinking, because I think the first thing I wanted to absolutely nail here is I think a lot of people have been messaging me. They really want to understand the differences between VCTs and EIS, and even I want to understand that. And what I'm hearing, I've written down a few key points from an investor point of view. I think one is the VCT has I would say a liquidity bonus in that you can trade your underlying shares basically under the VCTs. They're in some kind of publicly traded market, so you do have a liquidity option after the holding period. I think the advantage of the EIS could be that you have loss relief. So as a company fails, or if it doesn't quite work out, and when you're investing in early stage or company, these things happen, especially when you're first checking in some of these SEIS funds, having the loss relief can be really essential in spurring these companies. I think the relief going into one of these products is the same for both. So when you go into a VCT or an EIS or an SEIS fund, you get the same relief. The timing of it can vary depending on the type of
income tax relief.
Income tax relief, yeah. And then that can vary on the type of fund, whether if it's an SEIS and an EIS and knowledge intensive, the timing of when you get that relief needs to be understood by the client and or the investor. The capital gains tax freeness is the same for all of the products, right across with SEIS, EIS, or VCTs post the holding period. I think the holding period is longer. No. Is that correct?
Francesca, do you want to comment on the CGT?
Well, there's disposal relief and deferral relief. So in terms of any gains from an EIS perspective or VCT, when you buy back, it's free from CGT. But there is another added tax relief when you invest into an EIS, in that if you have had a capital event such as selling your company, or you sell a buy-to-let, selling some shares, you have a big CGT liability, you can use an EIS to defer that capital gain, and you can continue to defer it. The gain will only become live when we exit the company that we've used to defer the capital gain. So when we exit that company, the gain becomes live again. Now, at Calcas, we have a reinvestment fund, so you can continue to reinvest. I believe MMC also have a rollover fund, or reinvestment fund as well. So we can continue to reinvest that gain for you. And what we find is that people will choose just to defer it until the investor passes away, because then the gain dies with the investor. So in that perspective, I think that we potentially have a sort of older client demographic for the EIS versus the VCT. You know, people that don't necessarily need the cash are happy to defer a capital gain until later down the line, until they pass away, and then also they can benefit from the IH2 relief if they've held the shares for 2 years. So, and this may be coming off topic a little bit, but what I would say, generally speaking, is that our EIS investors tend to be slightly older than our VCT investors, who are usually doing it for, you know, the income tax relief. They're high earners. They want something that's going to complement their pension. They've already, you know, maxed out their ISA. They are business owners, and like I say, high earners, city workers. And that's your kind of classic VCT client, is an income tax relief play. Whereas with the EIS, there's a whole other suite of tax reliefs for them to take advantage of. So it really does come down to the client's individual situation.
One more relief, just one more sort of difference I've noted was the income tax. So when you get a dividend through a VCT, it's tax-free. So the income of your investments is tax-free, whereas most EIS underlying portfolio companies probably will not be giving a dividend anyway. But if they did give a dividend, you would have to pay tax on that income. So
exactly. That's why they don't. Yeah. And I think that before, the confusion was you thought that the dividend from the VCT was paid by the underlying companies, but it's not. It's paid. The dividend is paid by the VCT. So that was where the confusion was earlier in our previous conversations. That people
and post a lot. Sorry, Stephen, go ahead.
I was just going to, as Francesca summarised that so well, and I'm going back into being a nodding donkey again. Do you want to just round off, because I think Sunil made a comment about CGT from a VCT on sale. Do you want to just round off on that point for clarity?
Yeah, there is no capital gains to pay when you come to have a buyback scenario. So hopefully you know, the VCT has grown, and even with the discount to NAV that the VCT would buy back on, if you make any gain, then that's not subject to capital gains tax.
By the way, keep the questions coming in. I am reading them. I'm trying to sort of incorporate them into what we're doing. So if you have a question, keep coming in. I'll try to field it to our panelists. Sorry, Nish, go ahead.
I want to better understand the liquidity risk in the VCT. So, and the NAV. So you had, you know, in 2022, there's a lot of people investing in VCTs. My view is you shouldn't, because NAVs were high, and you've seen VCTs come down. At the same time, I still see a number of VCTs that performed really well during that period based on their reporting. But NAVs have held up relatively well. How strong is the secondary market? And what is the actual liquidity risk when someone is coming to the end of the 5-year cycle, or within the 5 years? What is the risk around that?
So can they exit or not, is what you're asking?
Yeah, I mean, if they do, what kind of price are they as well?
What kind of discount to have?
Yeah, so the secondary market it's a really good question. When you look at the share price, because VCTs aren't traded frequently, it's not a good indicator to look at a VCT share price. What you need to be looking at, as you rightly said, Nish, is the NAV. Now, there's not a secondary market, a really active secondary market, because there isn't much benefit in people buying shares on the secondary market, because they won't get the income tax relief. And we all know, you know, it's not just about the tax relief. You need to really be interested in the investment case as well. But of course, 30% is huge, and you can't ignore it. And it does really prop up the investments as well. So I think in terms of people buying on the secondary market, it's really low. So therefore, that's not that typical, because they will not get the tax relief. It does happen. We've seen it happen. I don't know who is doing it. I've never really come across somebody that said that they've bought on the secondary market, but it does happen. So the buyback is a different situation. So I'll talk from the Calcas VCT point of view. We monitor people that have come up to the 5 years and said, right, I'm coming up to my 5 years in April, I'd like to apply for a buyback. We add them to a list. We then see how many, you know, what the appetite is. And if it's enough, we'll do a buyback, which means that we buy back those shares. So it's not on the secondary market, we're buying back those shares. And that's at the discount to NAV. So we've always satisfied our buyback quota. We evaluate.
I'm just going to move. We got thick and fast questions coming. I want to try and get a few of them. I'm going to bring Tom into the conversation a little bit here. So, Tom, there's a question for you here, which I think is a good one. Are you seeing the popularity of EIS increasing over VCTs and SES, and what seems to be the driver of that from your perspective?
In a word, absolutely. So we did a bit of press on this around the time of the budget, maybe just before, where we saw that there was particularly an SEIS, but also EIS followed suit. That in the budget there was a sort of realm of tax reliefs that kind of were taken off the table, and obviously capital gains tax, business asset disposal relief went up, and we saw particularly with our advisors, our advisor base, that a lot of these were trying to get ahead of it, so allocating to EIS and SEIS almost preemptively to sort of have a sort of softer landing into the asset class. So I think the key driver, I would say, is the capital gains tax treatment on the way in particular if you've had sort of an individual event, so such as a property sale or a increasingly share sale event. People are using these schemes to not only count against the income that would have been off the back of the company as they were approaching that time, or the rental income of the property, but also sort of really kind of trying to mitigate the tax bill, because ultimately it's an extremely lumpy business for advisors, I'm sure, trying to manage the outflows. And I think the idea that you could have an asset that ultimately spits out a capital gains tax free growth, but also kind of very much makes it a softer landing when you're having to pay that bill, I think that was a key driver we saw. And that's just extended over the last few months. I don't think it's really slowed down in the last few months. I think as we approach tax year end, it's going to get even more popular.
Great answer, thanks for that. I'm going to bring it up one level. Just we're getting quite a lot of questions in around the sort of tax treatment, and I just wanted to just really cover it more broadly. And I think we've had a good discussion around the pros and cons somewhat. We'll come back to that. I think we all have different underlying companies that we invest in, and the reason why we all, to be honest, we collaborate with a lot of other EIS funds and VCTs, and we co-invest together. And we all have our different specialism, things that we're good at. So it'd be good to just understand a little bit from our fund manager, our funds and representatives, what kind of thing they invested in, why it suits our VCT or EIS, to bring it back to our theme of the topic. So maybe we can start with Nish. What kind of companies do we invest into, and why does it fit, an EIS or VCT, depending on who we come to. Nish, you first, and then we'll go Nish, Tom, Fran, and then me.
Yeah, so we predominantly invest into software companies at a seed or Series A stage. We think about them as transformative technology businesses that are building some form of foundational technological application or infrastructure. And we categorize it as AI, SaaS, data infrastructure. We invest into fintech and health tech as well. So we have one of the largest AI SaaS portfolios. When I say SaaS, I mean enterprise application portfolios in Europe. And often we look across Europe for companies when we first invest, and scope across the whole market, and these businesses then scale and go into the US. So that's our specialism. And one of the things that's, I guess, a distinction for us is that without making it into a pitch, is that we're research driven. And I think that's important to link to the underlying types of technologies that we're investing into, because if you look at the innovation around large language models and the disruption happening just this week, there was something announced about DeepSeek, which is a Chinese model, which is bringing down the cost of developing models and efficiencies around models, and how that's going to open up the whole AI application market globally now for innovation, for disruption, and that's an area that we've been investing into for 10 years.
So why does it suit like an EIS versus a VCT, which is what you are? Is it because it's not income generating, and therefore
these companies, exactly, they're not income generating. We at the stage that we invest, they're typically post revenue, pre-profit. They're not going to be free cash flow positive for 4 or 5 years, and over that time frame, they're actually going to continue to raise capital to scale and compete with global global peers, global competitors. And so really the premise there is capital growth. Are we going to exit these companies anytime soon? Where our average hold period is almost 6 years. And for a VCT, you have to have an established VCT, is my understanding, to be able to deliver that yield. Otherwise, starting a new VCT from scratch with that type of strategy doesn't work.
I'm going to come after these rounds of questions. I'm going to come to a more broader, as in VCT, EIS as an asset class. So we'll just prepare for that. So Tom, do you want to just reply to my earlier question? Which is what kind of things do you invest into, and why does it suit the type of structure that your fund is?
Absolutely. So Haatch was founded by Scott Weavers-Wright and Fred Sonia, who themselves had built and sold 2 companies themselves, the latter of which was sort of born out of a frustration that large corporate customers didn't seem to know much about e-commerce at the time. So really our specialism is in that area. I think you mentioned near the start of the call actually that the kind of perception about EIS and SEIS being more suited towards medtech, biotech, and so on. I can understand the assumption given that there's not normally longer lead times and research and development that's taken. I would disagree fundamentally because I think ultimately the schemes were designed to reward patient capital in the economy, but also to provide investors with kind of tax advantage returns to high growth companies with high exit potential. And I think that latter form is where we sit. So our team have kind of expertise ranging across a number of large corporates, which we can then lend to early stage companies and help them sort of sell in and build up those contracts with their large enterprise clients. So in a nutshell, the problem, where we invest is when there's sort of large problems being faced by large enterprise clients and in companies that are small enough and nimble enough so that they can fix it and whilst building value on the way there. But yeah, I think I've answered.
Thank you, Fran.
The calculus are generalist investors, but we do have sector sweet spots. We invest across technology, healthcare and biotech, and entertainment. Within technology, we look at B2B SaaS companies already generating a revenue. Typically, it's around £1 million plus a year. With healthcare, we look a lot at drug discovery and diagnostics as well. We don't typically invest at the university spin-out stage, but maybe a couple of rounds post-university spin-out. So it's when it's, we can see that there's some traction with the product. And then with entertainment, which is a bit of a diversifier for the portfolio as well, we invest in talent-led production companies that produce premium content for the streamers.
Thanks, Fran. So O2h is a fund, and we only do biotech. We're a specialist, which means that we can have we can do quite deep due diligence into the therapeutic areas, which is quite technical sometimes, and we have that within O2h group as itself, and external advisors who can help and support. And we do a lot of university spin-outs. We spin out from Dundee, Sussex, Oxford, a lot from Cambridge. Probably more than half our portfolio is from Cambridge, which is quite timely actually, given that or the Oxford Cambridge arc is fully in the news, and I've been fully sort of busy meeting sort of various people coming to Cambridge for that. Because we are the only early stage pre-seed biotech fund in Cambridge, which is like completely, a pure play biotech fund, which is, you would have thought there'd be lots of them, but there are funds here. Well, there are 2 or 3 other non-EIS funds, but they do tech and biotech. So, we actually have incredible deal flow because we're in the heart of the whole biotech engine really of the UK. And we're the heart of the government's growth agenda now, because, when a biotech raises money, a biotech will work on global IP, even though it's from Cambridge or Oxford or London or wherever, in Nottingham and other places. But when they raise money, they raise 30, 50 or 100 million potentially in later rounds. So, in terms of, sort of the growth engine of the UK, you can see why the government are really putting a lot of emphasis on life sciences and within that biotech in particular. So I think we're at the heart of that. We're a specialist fund. It just so happens, I think the EIS structure and the SES structure fits us very well. Because it can, you get the loss relief going out, but also when your exits come, it's potentially income tax and CGT free. So I think the whole structure works very well for biotech. I think it's the UK's best kept secret. Actually, when you tell the US investors that we have this structure in the UK, they just can't believe it. And quite frankly, it's if they had that in the US, they would be utilizing that scheme to the nth degree, because the private individuals in the US invest huge sums into biotech without all the tax advantages that we have in the UK. So I think it's actually a very well set up scheme. I'm really glad it's continuing. And I think it fits the whole biotech thematic scheme very, very well. And the reason why I think this panel works very well, I think, working in biotech, tech, and with other retail, and having a broad portfolio across a number of fund managers, I think works very well for private investors. And I invest my own, and I would also encourage people to have a portfolio. So working with other fund managers, I think, is really, really key. Stephen, over to you. Who do you think, coming back to you, who do you think the champion is, VCT or EIS?
It's very, very painful sitting on the fence to answer that particular question. I am going to go back totally to saying completely and utterly depends on what the client's after. We generally have portfolios in both for the vast majority of clients, which might sound counterintuitive given that we think they have very different positions. But I'd also like to bring a couple of planning points in to answer that question. Firstly, lots of advisors talk about categorizing clients' assets under readily realizable assets, which obviously cash would be a brilliant example of that. And then you've got realizable. So and totally illiquid. Now, for me, I categorize EISs as illiquid. I've got no control over when the money's going to come out. I believe in a decent sized portfolio, it's going to happen, but I can't influence it. Whereas the VCTs, once we've got outside the 5-year period, because of all the points that Francesca has already covered, I think it is much more flexible. We've got a chance to realizable. And indeed, as one of the commentators has put, you've also got liquidity giving more flexibility within the VCT, which you don't have. And that can be beneficial for a client. So bit of a woolly answer, but I just think they've each got their place for clients.
We've got a lot of questions coming. I'm trying to pick out ones which I think are sort of relevant and
well, whilst you're doing that, I'm going to keep talking. Just
yeah,
give
you
you
keep talking.
a
I'm just
chance.
gonna, so I want to answer some of the.
And again, VCTs have no place for inheritance tax planning, which was another question that was brought up. So clearly, seed and EIS does. But something I did want to get across, which actually Tom raised inadvertently when he was saying he expected a lot more new business coming in between now and the tax year end. We're still seeing and hearing, and not entirely anecdotally, about advisors who put clients' money in, forgetting that there can be a very long lead time before that money in the EIS and seed space is deployed. And given that you've only got a year to go back, you can get caught out. And sometimes I think the fund managers forget to emphasize that point. And certainly, at least one of you has got a knowledge intensive fund. You might want to just bring that point up, because I think that's very relevant in the conversation that we're having.
Yeah, we have a knowledge intensive fund, and we could discuss what that means.
How to butter up your chair.
Yeah. But Paul Matrix asked an interesting question. I think it leads quite nicely that the whole market really for investing into these types of venture type products has been difficult in 2023, and I've got data to support that. I do think, and the landscape has changed significantly. So I think I'm going to go over to Nish here to just say, like, what do you see, products aside, EIS, VCT aside, what do you see as the trends in terms of venture investing, and where do you see it going from here? And after Nish, if anyone wants to answer that as well, just raise your hand and I'll come to you, and I'll make my own points after that.
Yeah, it's a good question. So it's been very tough to raise for venture capital funds to raise new capital over the last 2 years, and there's various reasons for that. But what that means is that you're going to see consolidation in the venture capital market, and that's outside of EIS and inside EIS. You're going to see funds not able to raise enough to operate and continue deploying money. So there'll be a reduction in the number of managers, probably. I mean, EIS VCT is kind of unique because it's got the tax wrapper elements, and that does buffer it to a degree, but venture capital on its own right is going for a bit of a reset, and has done. As interest rates came down in 2022, we just saw the death of M&A and liquidity. There were no exits. That started to come back last year. We have our first exits since Q3 2022, and that's going to be in the next month. So that's positive, and we are, venture is very closely linked inversely to interest rates. So if interest rates start coming down, if you believe Ray Dalio and you think, okay, they have to be cut quite aggressively, well, that's a good thing for venture capital. And the other thing we've seen is the competition for tier one deal flow. And when I say tier one, I mean just the most attractive companies. We really compete with traditional venture funds at Series A for the kind of companies we're investing into. We don't charge the underlying companies fees. Anything to put off these companies from taking a fund manager's capital is something that we have to try and avoid. And actually, sometimes it is difficult to convince a founder to take EIS money or to go through the whole HMRC process. When you are positioning yourself as a lead investor as part of a big round, there's risk. If that capital can't be, if you can't follow through on that capital to that company, there's massive consequences on that business. And so the competition is actually pretty tough. And we're not just competing with UK funds, we're competing with European funds. So, it's really a
that's a good point, Nish. I mean, when we invest, and like all of us, we are, we're in competition with a lot of global capital coming into the UK and trying to invest in these companies. But I think a few points which I've seen, I'll mention, and people can comment, is I've seen that 2023 there was a huge reduction in the amount of venture capital globally going into portfolio companies. I think that was a particularly tough year. I think in 2024 we've seen quite a lot of the money come back in, and actually we're pretty much back on trend if we look at the overall graphs for VC investing. But the types of deals are different. So it's kind of fewer deals, but larger amounts going into them. I think that's to get around the financial risk, remove the financial risk of investing. And then obviously you've got the underlying technology and platform risk. So there's sort of trends we've seen in the pharmaceutical biotech sector specifically. And I think it's the same for actually, the broader spectrum of larger companies. They're all sort of M&A hungry again. And Nish, you mentioned that I think that when I was speaking to the larger pharma at the JP Morgan conference a few weeks back in San Francisco, you can see they're all looking to now acquire to build their pipelines up again. And there's obviously some of the larger pharma companies like the Lillys and the Novos with a lot of cash from the GLP-1s and similar things in the tech sector. So I think there will be a lot more M&A. I think because venture sort of funding reduced over the last year or two, the amount of deal flow we're seeing is incredible actually. And also I think that's for all of our funds, I can speak that. And I think the valuations that we're able to get into at later stage companies is different to what it was 4 or 5 years ago. So I think we can invest into slightly more mature companies at sensible valuations, i.e. the investors have a bit more negotiating power into coming into deals. I think that's changing quite quickly. I can see, what's happening in the US is, I think, now infecting us in the UK, in that we're all thinking about growth and we're hearing it every day on the news, etc. And I think what that will do will encourage entrepreneurs to get going, get moving, and start growing and building their businesses up. If we can catch the same disease that they've got in the US, which is really try to combat some of that growth. I don't want to make this political. I'm sure we've all got an opinion on how and if that affects, but that's sort of the general trends I'm seeing. I'm seeing fewer deals, larger deals. You could invest at similar valuations, later stage, and I think there'll be more M&A this year. That is my summary of what I'm seeing in the sort of landscape. Open to comment.
Yeah, I mean,
sorry, just the
sorry.
Tom first. Sorry, Nish. Tom first, because
yeah. Sorry.
I mean, to build on what you both said there, I think a lot has been made of this seeming reduction, which in a monetary sense is the case. In the last 2 years, it's slowed down and picked up slightly. But I think the wider context is extremely important within that. So in the last 2 years, we've seen there was a lot of foreign investment from Russia, from China in the UK, and China has decided that the UK isn't the place to invest anymore. Russia isn't allowed to. So I think levels have recovered, but I think it's more sustainable capital that's now investing in UK venture and capital that's more likely to reinvest at the next round. So I think whilst it is true in a sense that there is a reduction in capital available at this time, I think that combined with the fact that we've obviously got the Mansion House reforms that are going to unlock kind of significant capital later on for UK-based companies, I think the word consolidation gets thrown around a lot. I think in the case of our industries in particular, I think it will be beneficial at the early stages because it will become more relationship driven with how do you encounter with the mega funds and how do you ensure that they see your deal flow well. I don't anticipate anyone on this call will have difficulty in that realm, given that the focus is very much not charging portfolio companies fees. It's ensuring that high quality deal flow gets to the people who need to see it. I think it will be the people in the middle that get squeezed out, and they'll have to choose either to become a competitor with a very large fund, which will be extremely difficult given the bargaining power, or they're going to have to go extremely early and risk not being there already, which fortunately I think we all have the benefit of being. So I think it's an interesting time for the UK, given sort of the timeframes involved, particularly on EIS and SEIS, but I guess for VCT as well, you're looking at in kind of 5 to 7 years, which is our target sort of hold period, and I think relatively similar across the board. Are the companies going to be in a better position to maybe IPO? Obviously, it's been dead for a little while, or potentially get acquired on a secondary. And I think given how bleak things appear to be now, if you pick up a copy of the FT, I think that's a pretty good bet that they will be. So I'm cautiously optimistic about sort of the time frame.
Thanks, Tom. Nish, you wanted to come in on the point, sorry?
Yeah, Tom touched on it. It's the Mansion House Compact. I have to feel positive about this potential pension capital that's going to be unlocked. How much of it's going to go to venture, we'll see. But there is a gap in funding requirements at later stage. And a lot of that historically has been taken up by American funds, European funds. And we know the stock market's in trouble in the UK, right? And so the whole play is keeping domestic financing to invest into domestic companies, to keep those companies domestic as when they list. That's a very long-term strategy, but I am enthusiastic about the potential tens of billions of pounds that's going to be invested by DC and DB pensions into UK growth, whether it's any one of our themes. And that only bodes well for early stage investors. The ecosystem is going to get stronger. It means more liquidity, more exits, more growth finance for UK companies to compete globally. And we know we have a fantastic talent ecosystem here, and innovation is here. So that's, I mean, for me, that's.
To be honest, I was with Patrick Ballinster, so not to name drop, but one thing I was really encouraged by what he was saying is that this is about the growth agenda, and he mentioned scale up capital probably 10 times in 2 minutes, so they're very much on it. I do think the Mansion House Compact does need tweaking. I think when you speak to the pension funds, the fees that venture capital and the way they're structured and the kind of funds they would normally invest in mutual funds, there is a gap there and some base to fill, and also that the way they do diligence, they're very large pension funds into coming to. So there is a lot of work to be done to fill that gap. And right now, it's not that money doesn't necessarily go into UK funds; it goes into global funds. Our American funds coming over, and which are very established large funds, and taking advantage of the Mansion House Compact. So I think it does need tweaking to get some of that capital into UK companies. But I think the government have a very clear agenda. Whether you're politically wherever you sit, you can't. That is, I think, bipartisan, as it were, across the House. That everyone wants that mansion. It was started by the Conservatives. Obviously, the Labour government have continued to follow that agenda, and so I am hopeful on it. I do think it needs work before it actually starts working for us, and I think it's going to be a few years out before we see that cash really sort of infiltrate into our companies. But I agree that is probably the one biggest thing that could really influence investing in the UK and into our, as Nish puts it, our fantastic ecosystem of tech and biotech companies and retail and others. We have probably one of the best university networks globally. We have a lot of US, I'm speaking for biotech particularly, but a lot of the US funds come over, acquire our biotechs before we have a chance to really scale them. And I can give you sort of a number, like 10 examples in Cambridge where Japanese or large American companies, pharmaceutical companies have come and acquired companies which would have been, in their own right, global leaders in the pharmaceutical space, but we just haven't had the liquidity and the capital to be able to give the investors their return and inject these companies with the capital they need to really scale and grow. I hope that changes, but that is obviously a clear issue and problem. But there is, the Mansion House Compact is the only source of that level of capital that can really solve that. And I'm with the sort of with my BIA hat on. There is a huge amount of work being done behind the scenes to help and support the government with that initiative. So yeah, I agree with that point, Nish. And I've got so many questions. They're quite in the detail around tax detailing. I don't know if anyone in the panel wants to pick off, a bunch of these one by one, or not.
There's one that I can see that relates to the gifting of EIS and SEIS from parent to child. I think we spoke about it before. So really interesting, sort of something that spun out off the back of the budget. One of our advisors, I believe, proposed this, and it's something that I think is incredibly good, is that if you're looking to get around the inheritance tax and essentially you've got a child who, let's say, is 18 years old and heading off to university, rather than giving the money directly, if you're worried they'll be a bit flagrant with the spending of it, and if you're looking for a kind of nicer way to do it from an inheritance tax planning point of view, what we've seen is that, let's say you gift £50,000 to your child, and then they're able to claim either 25,000 or 15,000, either depending EIS or SEIS, back in the form of income tax relief. And then what that does is it can provide obviously a short-term cash gift to the child. And then also alongside that, it can sort of build up a portfolio of, you have access to the investor updates. You can kind of learn about the world of venture investing from a relatively managed risk point of view. So you've got the investment that you're kind of sat on. And then obviously at the time at which those shares exercise, it could be around the time that you're looking to buy a house and it will contribute towards that or some other living expense. And I think it's one that we published a case study actually that I can share after this. But I think it's an incredibly astute way of going about that issue, because a lot of people tend to fall into the trap. Obviously, the gift is contingent on the 7-year rule being hit. But I think, yeah, changing conditions result in kind of, adaptive thinking. And I think it's a really good example of that.
So it's just summarizing. And so if there's anyone on the panel that wants to say something they feel they want to contribute into one of the points I haven't said, please put your hand up now. Otherwise, it's going to summarize sort of what we said, and so yeah, Stephen, maybe you want to come in and
I'm just going to follow.
Stephen, why don't you do the summary? Because
no, but I do want to follow on Tom's point. I've read the case study that Tom's referring to, and I think it's technically perfectly okay. What I would say, though, from an advisor's perspective, I would be quite cautious about gifting some money to a child. Now, I've got 4 children aged between 24 and 30. And if I was going to be giving
Don't
them
look that
money,
old, Stephen.
thank you. If I was going to be giving them money towards a property, I wouldn't choose to do it via the intermediate stage of an EIS, mainly because of the uncertainty about when it'd be realised, which is my problem with that particular case study. I think as a route and as some long-term savings to put aside, completely agree, but perhaps not using that particular rationale with that one. I think the principle of it works. But giving money
Stephen,
across
after that, can you do the summary? Just so when you finish your point, just summarize the VCT versus the EIS angles and arguments. And
right, we all know, as we're almost going back to Francesca's summary at the beginning, and that is that from a planner's point of view, I want to understand the obvious things about a client's attitude to risk and all the rest of it. But actually, for me, that's secondary to coming down to what the client wants. Does the client need to have income? Does it? Do they want to have tax-free income? That obviously would instinctively lead me towards going to a VCT first. Do they have capital that they simply don't need? As planners, if we put money into any form of investment like that, we are quite harsh. We say, if you lost a lot, which I appreciate technically is incorrect because you do have loss relief you can offset, but we work on the basis they may not have income tax that they can offset against it and things like that. But if they've got capital they can afford to lose, we would ordinarily put it towards an EIS because of all of the tax advantages of an EIS or seed compared to a VCT. But if they want that income, particularly as Francesca has already spoken about, the buyback options, and although Francesca didn't really dwell on this, the fact that you can start building a portfolio which is well documented that recycles itself over a period of time works. And we have any number of clients where we've got tranches done each year and we're starting that recycle process so they can get that income tax relief twice over. Another small point following on from Tom's case study I've just thought of, sorry, that's not the summary, is do make sure that your child's got the income tax relief in the first place to be able to offset, which is asking quite a lot. I know that you would know that, Tom, and I didn't mean it any other way, but there aren't many 21-year-olds with that amount of tax relief, particularly if they're going to go from a student perspective. But can I do a techie point there? If they wanted to make sure they were trying to protect the actual growth, you don't actually have to have the entire investment get income tax relief to get the exit, which a lot of people don't realise, and that's quite important. So I think really what we're getting from this is both EISs and VCTs, plus seed, are wonderful tax advantaged vehicles, but fundamentally the point that has already been made and perhaps insufficiently reinforced is that it's all about the investment. Do you believe in the investment to start off with, and do you believe from an advice perspective that it meets what your client is trying to achieve? If those two aren't right, the rest of it is academic.
That's a fantastic point. And there's 2 points I want to make to complete this webinar. One is that I would invest my own money in any one of these fund managers, and whether it's Haatch, MMC. I think we've got to, and it just shows that the cooperation, the collaboration that we have within the sector, within the EIS. We can call each other up, not only these funds but others as well. We co-invest with each other a lot. We ask each other tricky questions which we're not quite sure the answer of, and how to get around certain things and how to support. And if any one of these, if one of my guys, or I call up Nish, or any other, and we do some co-investments with calculus, etc., and we work together and we cooperate. So I think that's an important message to get out to the community, that the EIS funds are working together and we're collaborating. And ultimately, it absolutely is all around the underlying investments in the products. And the fact is that the tax benefit is a bonus. That most other investors in other countries do not have. It's a real win for the UK, and I hope we can double down on that and show some, make these funds very successful. But ultimately, I think that it's down to the underlying assets and products beneath us. So on that note, unless anyone has a burning thing they really want to say, I hope I've given all the funds equal time each roughly, and everyone's got their points that they wanted to. If there's anyone that has wanted to say something and hasn't, please put your hand up. Otherwise, I'm going to call it time on this webinar. Thank you very much. Appreciate all your time.
Thank you, everyone.
Thank you.
This is recorded, so I'm sure that the snippets will go out thereafter. Thank you very much. Enjoy your Friday evening.